Once we have figured out where we are in the world of crypto and have a better understanding of how the game works, what drives the market, it's time to strategize a plan of attack. Before you decide to throw everything into one coin, consider your own risk tolerance, your reward ratio, what's your goals? Diversifying and balancing your portfolio the right way, getting the right point of entry can make all the difference in the results you want. Before you get started investing, it's always good to think about your portfolio balancing, how you want to balance it. There are different ways to think about this, and I don't want to overwhelm you with information, especially in the beginning. But keep this in mind, maybe in the back of your head, or just slowly marinate on the thoughts of how you might want to construct it. Just to get you an introductory look at how you can develop a strategy and how to balance out your portfolio is, if you want to stay conservative, stay majority into large caps and a little bit into mid caps and very, very small portion into small caps. So now this is, in case you don't understand the different terminology, large caps just means the coins that's higher rankings, more well known, less likely to go away anytime soon. Risk reward factor means lower risk and lower reward. Now with the small caps, it's quite the opposite. So they're lower down the rankings with higher growth potential within the crypto market itself. And then you have to factor in the risk and reward factor, which is you don't know how well they're going to do. So it's higher reward, a higher risk. But if they do well, you have higher reward. And the mid caps is the stuff that we recognize. They're not quite big caps. They're not quite the large caps, but they're recognized enough where they're not small caps. They're not so risky, right? So this is just a way of looking at it. I call this the more conservative way of investing. This is more aggressive way of hodling. Hodling is just, we went through the memes. Hold on to their life, right? This is just put your money in. You're not going to do any trading. You're just going to keep your faith and it's going to go up, right? This is majority of people are going to invest this way. By investing this way, you still have to balance it every once in a while, because certain things will grow faster than you expect. Certain things might not grow as fast as you expect. So after a little, some period of time, you might want to readjust things. So this one, like I said, you go by your own percentages. This is just a mental picture of how you can construct it. You go large caps, mid caps, small caps, however you want to break out the ratio. But the thing I want to introduce to your mind right now is ICOs. Now, this is something that is comparable to IPOs in the traditional stock markets. Is basically the very first time, initial time that they're going to offer your investment into this project. So with ICOs, you can get in on projects before it's even listed into exchanges and get in on it in the early picture. So ICO is something you want to dedicate some of your portfolio into if you're going to play the long-term game, because with those you have more flexibility. You can cash out as soon as it hits one exchange. There's many different strategies I will go into, but this is another way of looking at it. The next one I will talk about right here is somebody that's going to be a balance trader. What I mean by this is just something I'm using, a term that I'm using right here. You're going to be invested for the long term. As you can see from the 20%, this is, again, arbitrary breakdown, but 20% in large caps, 20% in mid caps, 20% in small caps. That means I'm holding those. I'm not even, I'm just holding it. I'm just hodling with those portion. So that's 60%. I'm just hodling. 20% in ICOs, which if you want to count as hodling, that's 80% in hodling. And then you have 20% in trading. So with that 20% and whatever breakdown we want to look at, if let's say this is $10,000, you're going to have $2,000 you're going to use for trading. And trading is a totally different ballgame than investing. Most people are going to be familiar with it when it comes to traditional stock trading, day traders. Some that might not be too familiar, I'll go over it in the later videos. And for today, in just the portfolio balancing, this is just an idea that you don't have to be totally a day trader to do some trading and make some profits. And there's a very good way of doing this and growing your portfolio so you have more flexibility to invest into ICOs without depositing your own money. Of course, you got to do it right and have some skill and probably luck along your side, right? So this is just another thing I'm introducing to you so you can consider it. This is more for fun. Okay, remember this, for fun. This is something that a small percentage of people, but definitely are out there, that will construct their portfolio to balance out with something like this, where it is very small percentage, as you can see, 10%, 5%, 5% into actually holding. This is, like I said, it could be even smaller than this for some people. A lot dominated into ICOs and a good portion. So if we're talking about professional traders, some of their portfolio might actually be like 90% or 80% trading portfolio, where they just trade day in, day out with that balance, and then they'll invest very small amounts into the side. So it can look very different, but this is just for you to understand that some people in the market are not holding long term. So when you think about when the market goes down, where did all the money go? It technically could be just sitting on the sidelines and waiting, because those are people that just said, hey, you know what? I'm not going to let my money go through that down period, and I'm not going to experience through all that hurting. I'm going to take a chance, cash out right now, and just sit on the sidelines and wait until the market hits a bottom, and then I'll come back in. So people are thinking, oh, all the money went out because they're scared, they're never coming back. But a lot of it is just smart money sitting on the sidelines waiting for the bottom, and then they'll come back in. Timing the top and the bottom is very hard. Day trading is very hard. I'm not recommending this. Not investment advice. This whole portfolio chart is not investment advice. It is purely just to get you to consider different ways of going about this, different approaches that people use, and different approaches you can use based on your own strength. This is something that, again, I'm not recommending. It's something that I'm doing and have been doing with some success. I call it flow just because I love flow. Being in the flow. Now, flow just means it naturally kind of circulates itself for me. I don't want to go too in depth. I'll go into this more when we're talking about technical and trading and all that. But I have very little in large caps and mid caps, and a lot in small caps and ICOs. I do a little bit of trading, as you can see, not very much, and I stay at least 10% cash. Just, I don't mean sideline. I mean, yeah, that is sideline, as you can say, but I do that just because in case there are any good deals that a certain coin hits a big dip, or Bitcoin overall, the whole market goes on a dip, I want to at least have 10% cash ready to buy in. The 10% trading is 10% cash. You can almost mix match those, like 20% there, that sometimes I'll use the 10% into trading, because if I'm so sure about it, I'll put a little bit more, be a little bit more aggressive, get in, get out, and I'll still have the 10% sitting there for cash, right? So I mix and match those into percentages. The reason why I constructed this way is because ICOs and small caps have higher potential of growth. The movements are usually 30% compared to Bitcoin's 5%. That's just ratio, okay? So when these things go up, I'll have much opportunities to scalp. And what I mean by scalp is that as soon as it hits one big jump, I'm not going to cash out all my position. I'll take maybe, let's say, 15% off the top and put it into Bitcoin, put it into Ethereum, put it into one of the mid caps. So I'm continuously growing my large cap and mid caps through scalping off of the small caps and ICOs. And this becomes a cycle, and as I earn more from trading and depositing more fiat, I can put into more ICOs, put into more small caps, and as they grow, put them back into mid caps and large caps. So this is just kind of a flow of me balancing out periodically, without me having to set specific times to say, hey, it's been 6 months, I need to balance out my portfolio again. I'm naturally doing this on day-to-day, month-to-month basis, right? So this is always happening. It's worked really well for me. Something to consider, right? I'm not recommending it. It's just something to consider. So one of the frequently asked questions would be if you can invest in Bitcoin if you had less than, let's say right here, $8,000. Where back, I was showing you in the history, it was back at almost $20,000 a piece, right? So a lot of people, especially if you haven't gotten in yet, you're thinking you missed a boat. How am I ever going to afford to pay for invest in one Bitcoin? right? I don't want to start with that much, or even one Ethereum for that matter. What if I wanted to start smaller? There's a misconception, and just something that newbies hit, is that you can buy fractions of a coin, of any coin almost. In Bitcoin, this is commonly referred to as Satoshi. It's a way of honoring Satoshi that wrote the white paper. So this amount is, if you look at here, CoinMarketCap, if you go to BTC, everything is measured in Satoshi, meaning because people trade altcoins into Bitcoin, right? Because some people make profits that way. I told you back in the days when people were mining, they were going from small altcoins into Bitcoin, so they have to know this number. And this number became known as Satoshi, meaning however many points, numbers you see here equals one Bitcoin, which is equals to, this is however many Satoshis equals one Bitcoin. So each different project, each different coin will have a Satoshi value, and this is what's going to be traded in the different exchanges like Binance, Bittrex, all these different Coinbase. When you want to first buy fiat money, your USD or whatever currency you're using into crypto, you're going to be buying it in these Satoshi values. You're going to be buying Bitcoin probably less than one if you're going in small first, right? So it's very simple to do that. You decide on the amount you want to invest, and Coinbase or whatever exchange is going to give you that decimal place of a Bitcoin, and you can use that decimal place of a Bitcoin to trade with other coins, the same as Ethereum and so on. So Satoshi and fractions of a coin is something to be aware of in the cryptocurrency market. It's not like traditional stocks where you have to own a full unit. You can own fractionals of a unit, and when it goes up, you get that same amount of value in gains. There's no change in that. It's just a different way of doing math. It's confusing at first. I can tell you it is confusing at first, but I can't really predict how fast you'll get a hang of it, but I'm telling you, it is going to be pretty quick. After a few times, a few weeks of you just checking in randomly, periodically, just at your own times, at your own pace, it's just going to naturally click in. It's just one of those things that we're going to pick up as we get more used to crypto. And this thing didn't take very long for it to sink in. So I wouldn't put this as something that you're going to have to study. I'll share a more practical tip with you. So as you think about portfolio balancing and how you want to, what type of coins you want to invest into, let's just keep this example very simple. Let's just talk about Bitcoin. If you were thinking about getting into Bitcoin, and just Bitcoin by itself, none of the other coins need to be considered at this time. If you want to take into consideration all of the market cycle, market psychology, and where we are in the market, if you try to remember that, and we do a practical example. Right now, I can only show you what we have currently. I can try to play around a little bit and show you maybe a couple of different examples to give you some practical looks. But let's just use right now as an example. There's going to be a common phrase that you'll see in traditional investing or in crypto investing, and many people is going to be recommending this because it's very safe, it's tested, it's safe. It's called dollar cost averaging. That just simply means you have a set amount that you are willing to invest into the market, whatever market it is. That set amount you're going to break into equal chunks, however many chunks you're thinking. It could be 10 chunks, 20 chunks, whatever it may be. And you are going to invest that small chunk every set amount of time. It can be every week. You're going to go on Friday, I'm going to invest $100. Next Friday, I'm going to invest $100. You're going to invest until your total amount runs out with that periodical type of investing. The reason why this is safe and it's been tested is just regardless if the market is going up or down, by you picking your time of entry over the long run, you're going to be hedging against the ups or the downs. So you're hedging yourself against a swing. This is a way of going about it if you don't have time to pay attention to the market, day-to-day moves, even week-to-week moves. You just you want to be in the market. You don't want to do too much research. You're pretty confident. Hey, we're in the early stages. I'm in it for the long run. I don't want to think too much about this. I'm just ready to go in. That's totally fine. And if you're going to do that, dollar cost averaging, spread it out, and you can make it work pretty safely. There's not too much psychology or tips I can get into that. It's just that straightforward. If you want to go, it's pretty safe to go about it doing this way. The thing that I want to provide you the tip on is for the people that want to be more dedicated in managing your entry points to try to maximize your profit or limit any potential downside, and maybe get in bigger chunks at a time depending on the trend in the market. Remember, we were talking about we have these big bull runs up, and we have the sideways market with the bull trap. Remember the chart? There's a bull trap here and another bull trap here. Sometimes it's just one bull trap here. So the sideways moving market. So when you think about all these, there should be different strategies you consider when you're in different types of markets. First of all, you have to recognize it. Now that takes a little bit of practice. It's going to take a little bit of time. But once you start to recognize it, or at least your instincts might be telling you, hey, I think this is pretty high right now. I shouldn't go in. Maybe at the time you should just hold off and wait a little bit and see what it does. It's the times when things are just going up, you don't want to wait too long, but you have to be able to tell the difference between when you are a little late to the party or you still have plenty of room to go on the way up. So people that were getting in at this time, yeah, even though it's going up on a straight line, you should be getting in. Now, when you're in the time of, when you're not seeing the big picture, you're coming from here, moving your way over, that's going to be much harder for you to make these type of decisions. That's why dollar cost averaging is always going to be safe. But if you're doing your research, like I'm encouraging you to, I'm here encouraging you to do research even before you start investing. I didn't even get to the how-tos yet. So this is all mental preparation, research game before you even put in your first dime, put in your first dollar, right? So consider if you were looking at the market and you were around here. So I would consider this a upward trending sideways market, because at this time we've been trending up for a while now, because we're getting up to 6,000. We were coming out from 1,000 or let's say 2,000, coming all the way up to 6. You would know that we've been on a pretty steady run, but this is not a hyperbolic type of move. So at this time, you can probably, I don't know how you're gonna proportion your entries. Okay, I can't tell you that part. Not investment advice. This is just different ways you can consider of approaching it. So if you're looking at a upward trending market, not a parabolic move, you can be a little bit more aggressive in getting your money in a sense, because hey, if I wait too long, this thing's gonna go way past what I'm currently thinking here. Then by the time I'm buying at 8 or 10,000, then my money is going a lot shorter than if I would have got it in now, right? So that's one way of thinking about it, but you have to be sure, or not sure, but you have to have a pretty good idea of where you are. Now, if you're here early December to early January, and you were one of the people, let's say, looking at a 1 month chart, you're looking at it almost like this, right? And you're on your way up, and you are getting in around 10,000. At this time, would you be thinking about dollar cost averaging or getting chunks in at a time, or are you going to be holding off? At 10,000, it is already a little scary compared to where we're coming up. This has been fairly steady, with this bump being a little scary. But with that bump being a little scary, they had a little correction already. So generally speaking, after the bump, we see the correction and we see sideways. It didn't go sideways, it went straight up again. So this is unpredicted. This is the run that not many people were able to say, whoa, we're going to the moon. Like when we were on this run, people were all, it was euphoria all over the place. I mean, people became millionaires. The really long-term holders became millionaires. Even the people that got in just a year ago has tripled or 5x their money. So this is euphoria phase. It's hard to predict. So if you were thinking about dollar cost averaging in, you're safe. If you're thinking about getting chunks in, you would have been safe. If you would have been waiting on the sideline, you would have probably been kicking yourself. But if you were to come into this point in time, you realize that dip coming up, this is a time when you have to be careful. So when you have that parabolic move up and it's dipping, this is when you have to. This is when a lot of people that I was close with and talking to were all paranoid or all nervous, like, hey, I think we hit the top, we need to get out. Whether you're a trader or you're an investor, at this point in time, you're thinking about protecting your money. So even if you're just going to sit on the sidelines, not that you're going to jump out of the market, period. So that's a little bit more of the advanced tips I was telling you, where you can even profit during a down market, or at least without going into detail for leverage, just taking your money out, sitting on the sideline and waiting for a better opportunity to buy at a lower price. You have to consider the long-term and short-term taxes involved in that. I don't want to get too deep into that. Short-term trades, you're going to get taxed higher. Long-term trades, where you're just buying something and holding for more than a year, you are in a different tax bracket, which is lower. So that's way more advantageous if you're going to do at least a year or longer after you buy into something. But after certain parabolic moves, and depending on your position size, this is something that many people were talking about at the time. Once we hit 17, got that dip, people thought, hey, you know what, this might be running out of steam, we might be near the top here. And they would have been right. So now we're coming back down. Since that time, if we're going any way forward, if you would have been sitting on the sidelines anywhere from 17 to 19, you're smart if you time the top, right? Even all the way down here, when you hit this second bump, if you were to realize, hey, you know what, that was it, this is the second head and shoulders pattern, let's get out here, 17, 16, 15, you're still looking good, because we dropped all the way down to 6 from what I remember. Yep. So during this time, if you think about dollar cost averaging, you take your sweet time, right? Like if you know you're going in a down market, by this time you can recognize that it's going to be a down market by here, right? When you get to here, you know it's a down market. People are panicking, people are just FUD news everywhere. So at this time, as soon as you get to this emotional state, when you read the articles, you're probably looking at articles that are talking about regulations, people are scared everywhere. Is it going to go down to, people are going to be predicting, oh, it's going to hit 8,000, it's going to hit 4,000, it's going to be outrageous, it's going to be 2,000. You're going to hear all this stuff around this time when you get that big dump. This is when, take your time, because you don't know where the bottom is. You don't have to go heavy into it. Dollar cost averaging isn't even that smart at this time, because just wait until we get to a really low level, and once you basically reverse the dollar cost averaging from the bear market I was telling you about. Instead of getting big chunks in, reverse it. Go small, 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 small. And as you get lower, go slightly bigger, go really big, until it gets to a point where if you're completely new to the market, this is going to be hard to say when is the bottom. It's going to take a little bit of technical analysis for you to understand this, because it's based on volume, it's based on history, it's based on Fibonacci retracement levels. There's all these tools you can use to provide yourself with an educated guess. No one's going to be right on this, but with those tools, I was able to time the bottom and buy the dips all the way down. I mean, looking like a genius backwards, but this is probably not something I can do all the time. But if you are really keen on following up the technical analysis as well as the fundamentals, and have patience, this is key. When you're in a down market, in a bear market going down, patience is key. So this, for all the newbies that's probably not in here, I'm going way too advanced in this episode at least. So the main key point to take away here, dollar cost averaging is safe. If you happen to recognize you're in a bull run, consider larger chunks. If you recognize you're in a bear run, reverse that. Go small and then big later as you get down to lower numbers, or you finally found that bounce that has huge volume supporting it. Start getting your money in there. So those are just some tips for dollar cost averaging to keep in mind. These are probably some of the more simple concepts to understand, because it translates very easily from traditional portfolio diversification, and dollar cost averaging works the same way in any market. The key takeaway would be to understand the different approaches the investors have in this market. We have some that's predominantly going to be holding for the long term, and there are the day traders and market movers, aka whales out there, that take a very different perspective and different approach to the market. Understanding the market cycle will help you with the point of entries, and whether that's dollar cost averaging or more precise entries with bigger chunks when the opportunity strikes. When that meets your research and preparation, some may call that luck, but I say that's when you are going to profit the most, when opportunity meets your research and preparation. And this is what I'm going to be encouraging you to do all the time. So make sure you give me a like and subscribe. Any more questions and tips you guys want, I'm looking forward to them in the comment section. Thank you guys so much for your support already. I will definitely have a lot more quality content, quality tips, and ways to help you maximize more profit in this market.